Okay, our next presentation is focused on artificial intelligence and using that to educate and help financial traders. And to talk about that, are we ready? Just make sure we've got everyone ready. Yep. David Jones is going to be here from Capital.com, so let's give him a round of applause. Come on out, David.
Thanks. Good evening, good afternoon. I'm going to talk about a couple of things today. First of all, the realities of financial trading, and the reality is most people lose when it comes to financial trading, and what we're doing as a company to try and improve the odds for clients to make money. Now, if you have had little experience of financial trading, it's a really strange industry to be in. It's an industry where whatever you do for your clients, most of them are going to end up having not the great experience they first thought when they started out as a client. So our business, we were founded in 2016. We have 300,000 plus clients around the world in 53 countries, 1,000 plus markets available to trade. And I think the thing that makes the difference is education and this algorithm that we've developed to try and pick up on mistakes clients make. So first of all, let's just talk about the reality of trading financial markets. Whatever the market it is, whether it's the DAX, the Dow, the Euro, the price of gold, the basics of financial trading are actually pretty straightforward. What you want to do is buy low, so you buy at 10 and sell at 20. Or if you think a market's going to drop in value, you want to sell at 20 and buy at 10. So on the face of it, financial markets are not that complicated. You want to buy low and sell higher. But the reality is, people trade these markets using leveraged products. So products where, for example, if you put 1,000 euros in your account, you could have a 10, 20,000 euro exposure to a market. People trade these markets using leverage. And I think one of the knock-on effects of that is fewer than 30% of traders are consistently profitable. So if you take in a year, let's say you have 10,000 clients trading through you as a broker over a year, in a year's time, maybe 30% of them will show a profit on their account, but 70% will sit there and kick themselves and think, why did I ever start financial trading? It's one of the most bizarre businesses out there. Maybe not the most bizarre business out there, but whatever you do as a company, the weakness lies within them. So this is what we're trying to address. So financial trading isn't so much about what's happening in the economy, what's happening with the European Central Bank. It's all about what goes on in your clients' heads. So this is something that we've started to look at. So what are we doing? So we recognize the importance of individual trader psychology. The weakest link in any trading plan, whether it's trading the euro or trading Bitcoin, is what's going on in the trader's head. So we're doing a few things to try and pick up on that. We've got a bias detection algorithm, so it's patent pending on that, and it looks at what the client has been doing, what markets they've been trading, how they've been trading it, what their risk looks like, and tries to pick up on a set of specific behavior. So whilst you have plenty of trading systems out there that look at pattern recognition within financial markets, we're applying that pattern recognition to individual traders. So we're looking at clients and looking at a series of trades that they've done and seeing if they have a bias for that particular market. So when a bias is detected, so when our algorithm picks up on, for want of a better word, a bad habit that a client has picked up on, we send them a message to try and give them a very subtle nudge in the right direction and to stop doing what they've been doing that maybe has been causing financial damage in their account. Like most companies who operate in this area, we can't offer advice, but we can do a lot when it comes to education, to pick up on these bad habits. So I thought I'd go through some of these just to demonstrate how this sort of thing works. So common hurdles to trading success. So no matter how clever somebody thinks they are, how much experience they have of maybe economics, the reality is probably 70%, slightly more, of people lose. So we've looked at some of the reasons why people lose and what we can do about this. So common hurdle number one. This really is, I think, a fundamental part of human nature, and we've seen it in an accelerated way in recent months when it comes to cryptocurrencies, and the likes of Bitcoin is, of course, the classic example. But trading against the market trend. It's human nature. If a market is going up, most people's brains don't think, well, this clearly, there's some positive news driving this market. There are lots of buyers driving this market. It's got momentum. It could well go higher. What the vast majority of people think when a market is going up, it can't go any higher. I have to sell it. I have to try and profit from this market crashing. So people cannot trade with the trend. And of course, the flip side of that, if we have a market that's been falling, like, to link it back to the cryptocurrencies, like Bitcoin has since the third week of December. So it peaked at around about just shy of $20,000 Bitcoin. It crashed again over recent days when a South Korean exchange was hacked. So the price of Bitcoin is now about $6,500. But all the way down from 20,000 to 6,500, people have been trying to pick the bottom, and people have been getting burnt. So it's human nature to think we know better than the prevailing trend in the market. You know, if you see, let's say the price of Netflix shares, which have done that, or Amazon shares that have done that, what are the chances that you pick the absolute high? It's highly unlikely. It's much less painful and usually more profitable to try and go in the direction of that major trend. So what we do on this is a really common problem. And I thought I'd use a recent example. This is pound US dollar. So our clients, currencies are a very popular market in the trading world. So whether it's the euro against the pound against the dollar against the yen, Bitcoin in US dollars, whatever it is, currencies are really popular. Over the last 6 to 8 weeks, the pound against the US dollar has been under a lot of pressure. So Brexit, of course, the B word that we just get sick of hearing about, is one consideration, but also concerns that the Bank of England wasn't going to raise rates. So what happened was the pound dropped something like 7% against the US dollar from late March to about 2 weeks ago. And all the way down, what people were doing was buying in. And this gets exaggerated, of course, because if you're buying in using leverage, 1,000 euros can control up to potentially 100,000 euro position in a market. Okay, so when we have a market like this that dropped 7% in about 6 weeks, very quickly you understand why leverage cuts both ways. When it goes wrong really badly. And what most people were doing was trying to buy and trying to call the bottom all the way down and losing money. So our algorithm will pick up on this. So if the algorithm looks at the last 10 trades the client did, and the market was doing that, and the client was doing that, or the market was doing that, and the client was doing that, then we give them a little nudge. We send them a message. So we say, for example, during the last 20 trades, you mainly entered long, that means you were buying, you mainly entered buy trades during a market that was moving down. Learn about a trend trading approach from this article. So we push them in the direction of trying to reinforce this lesson that the market probably knows more than you do, and you want to go with the bigger move in the market. It's not going to make them profitable overnight, but it does highlight maybe a really common trading weakness amongst more than 50% of clients. You know, it highlights maybe the mistake they're making. And this happens in real time. So every time, so this is an example after 20 trades, if on trade 25 they're still doing the same thing, then I'll get a nudge to a different article but with the same sort of message. So what we're trying to do is continue to reinforce this lesson about this is the mistake that you're making. And don't forget, in this business, more than 70% of clients lose. So we're trying to make a difference here and highlight maybe some of their bad habits. Another really common mistake is poor risk management. Trading, whether you're a trader or an investor, it is all about managing risk. It doesn't matter how good you are at forecasting markets. If, for example, you risked all of your savings and all of your trading account on just one trade and it goes wrong, you've blown your account up, so you can't trade again. So again, we really look at things from a risk point of view, what clients are doing. For example, let's say you bought some shares in Netflix, and Netflix was trading at $300 a share. And Netflix came out with a series of profit warnings, and 3 months later, it was trading at $200 a share. If you sit there through that whole decline, you've lost a chunk of money. You've lost 30% of your money in that position. What you can do is place stop loss orders. So you can place orders saying, I've bought Netflix at 300. If the price of Netflix drops to 270, if it drops 10%, take me out. So take me out with a manageable loss. It's a really sensible way of approaching financial markets, to decide right from the start, right, I'm buying this here, but if it goes to here, I'm going to get out. The problem is, that's a very sensible approach. The problem is, human nature and ego gets in the way. And I think too many people, when it comes to financial trading, they have a real problem admitting that they're wrong. So again, we are going to try and give them a little nudge to suggest that maybe having a plan, if things don't turn out, is the right thing to do. So again, the algorithm will look at their activity over the last 10 trades. And let's say in the last 10 trades, 7 of their trades have lost them money. And on those trades, they didn't have an order in to limit their risk. We will again send them a message suggesting that maybe they should consider placing orders when they first open up their position or open up their investment, have something in to protect them if it doesn't turn out as they were expecting it to turn out. So again, we don't sort of push it down their throat, but give them a nudge. Another mistake that traders make, so we have mistake number 1, they don't have a plan for getting out. We try and reinforce that. Another common mistake is setting the stop loss too tight, so they don't give the market time to move in their favor. I think this is one of the drawbacks of maybe the connected world that we live in, just from a trading point of view. It's far too easy these days to pull out your phone and sit there checking prices every 10 minutes. So it's made clients much more short-term than they were 10 years ago. This is great for businesses like ours, because obviously, like most businesses, we want client activity. If clients are trading, then there's a little bit of profit from us, via a commission or via a spread. But in reality, it's made people far too short-term. So again, another thing that we look at, are they just being too aggressive in their trading? Are they placing their orders to get out a little bit too near to where they get in? So again, we will send them a message, just giving them a push in the right direction to think about how they're trading. So if they don't have a stop loss, just a message reinforcing that good trading is all about managing and protecting losses. So know about the importance of stops. Or stop loss too close. This is a common one. If people trade, people love volatile markets. So our clients, like most clients of most trading companies, they love markets that do that all the time, that are crazy markets. Let's go back to Bitcoin as another example. Bitcoin has dropped something like 10% since last Friday, and we're only at Thursday. So we've seen a big move in Bitcoin. And it's human nature to look at a 10% move like that and think, well, if I'd have put 10,000 euros into that, I'd be sitting on a 1,000 euro profit after less than 6 days. So again, we will try and reinforce that maybe the client wants to take a step back. Don't get too sucked in to what's going on in the really short term. Take a step back. So the second message there, more than 60% of your last 20 trades with a set stop loss were activated. So they're setting a stop loss, they're managing the risk, which is the right thing to do, but they're getting bang, 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 just taken out very quickly. So they're not giving the market time to prove them right. So this is again, I think, another common problem. It's human nature that to make money in markets, the classic cliche is you let your profits run and you cut your losses quickly. So when a market is going in your favor, you should sit there and be patient and expect maybe more profits to come. If a market's going against you, you need to be impatient and realize you were wrong. But again, your ego gets in the way. What people do in reality is completely the opposite of that. So they will buy the DAX or Netflix, and they'll see a profit of 100 euros, then they'll be petrified that the evil market is going to take their profits away. So they snatch at their profits really quickly. And so they'll take profits too quickly, and they'll buy, again, let's use Netflix, and they're losing $300, and they'll sit there and think, no, it's fine, it's going to come back. And then in a week's time, they're losing $500. And they think, no, when it gets back to a $300 loss, I'll definitely come out then. Then a week later, $7. And so you see how the whole thing goes on. So the psychology of individuals trading markets is completely upside down because it's human nature. We don't like admitting that we're wrong. That's the really big problem. So again, what we will do without explicitly saying, because nobody definitely knows where a market's going to go, but we can pick up on these patterns of repeated mistakes. So getting out too quickly is a common problem. And again, just looking at what they've done so far, looking at how they've been profitable in the past, if they have been managing risk, carry on doing it and carry on using stop losses that way. So we'll have them thinking about volatility. It's no good getting out of a trade very quickly if a market is usually volatile. It's no good, for example, buying Bitcoin. I hate to keep coming back to Bitcoin because I think it is a crazy market from a trading point of view, but it's a great example in terms of volatility. It's no good buying Bitcoin with a stop loss 1% away because you'll just get taken out in the volatility. Now, so far, this has been quite negative. I keep talking about people losing money, which isn't very good for somebody who works for a trading company. But the reality is most people do lose money. But our artificial intelligence approach is not just for losing trades and losing traders. It can look at patterns of traders when they are successful. Because one of the problems is, I think if you have a run of success in financial markets, you can suddenly think that you're Warren Buffett and you can do no wrong. And the temptation is to maybe break rules that you've had in place before. So our algorithm will pick up on a string of successful trades because it is easy to get carried away and think you're never going to be wrong again. So overconfidence after a winning streak can mean taking bigger risks. So again, it will send a message saying, you've been successful during the last 10 trades, but remember to stay clear-headed, find out how overconfidence can influence your decision-making in trading. So the idea is to hopefully make them think about why they were successful over previous trades, probably because they had some sort of trading plan, and to make sure that they stay on track for future trades. Because the problem is, I've been trading since the mid-1990s, and there's been so much change driven by technology in recent years, and particularly the last 10 years or so. And I think the very first trade you make, if you open a trading account, you give an awful lot of thought to trade number one. You think, I'm going to risk this much money, I'm going to wait till this happens, I'm not going to sit there and jump in and out. And I think maybe for a lot of people, the first trade they do ends up being profitable because they put so much thought into this. And I think the problem is, if you then have a string of winning trades, it's probably one of the worst things that can happen as a new trader, because you suddenly think, well, this is really easy. I'm going to quit my job and remortgage my house and just make my money from trading the Dow all day long. And I think it's the worst thing you can do. And as you get sort of, if you have this winning streak, you forget the rules that you put in place in the first place to have this winning streak. And it goes back, I think, to what I was saying at the beginning, where only 30%, if that, of people, it's less than 30%, are consistently profitable, because it's too easy to have a run and then suddenly you start breaking all your rules. So again, we will look at patterns of traders that are successful just to remind them not to go off the track that they planned out for themselves at the beginning when they started trading. So none of this stuff, we're not forecasting where the market's going to go, but what we're trying to do, we realize that a good trading platform, a good trading app, yes, it needs to have lots of news and prices and markets and all this sort of thing, but that really it's not that functionality that's going to make a difference for traders. It's if we can help those traders with what's been going on in their head. That's the thing that's going to help make them, hopefully, more profitable traders. It's not going to change, I don't think, that the statistics overall, but we are hoping this approach that we take with our clients will maybe give them an edge over other participants in the market who don't realize how important their own psychology is. Does it work? This is, of course, the acid test. It's great to talk about this and say we're doing this, we're doing that, but does nudging traders and investors actually work? The quick answer, you won't be surprised because I have a slide on it, is yes. So there was some research done with real investors trading on sort of demo money accounts about 2 years ago in Italy. And the research does reminding of behavioral biases increase returns from financial trading. So there are a bunch of students enrolled on an economics course in an Italian university, the University of Calabria, and they could gain extra credits by running a fantasy portfolio for 5 weeks. So some of the students enrolled for this fantasy portfolio. The students were split into two groups, so they didn't know they were going to get split into two groups. They were ignorant of what was going on with the other groups. One group received messages along the lines of the ones I've been talking about. So if they were taking too much risk, if they were trading too frequently, they'd get messages that tried to maybe steer them in a slightly different direction, and the other group didn't. So the other group were just left to get on with their fantasy trading. At the end of the 5-week period, the message group had improved their trading performance by 1.8% compared to the other group. So we did see here that it did have an impact. Now, I don't think it's going to have an impact in terms of hundreds of percent a year, but just making people aware of how important their own psychology is in the business that we're in at Capital.com, we are hoping has a more positive outcome for more of our clients than has been enjoyed by plenty of people trading in the past. So in summary, most people's experience with financial trading is that it's not as straightforward as they first thought it would be. It's too easy to blame external factors. The evil market is taking my money. The European Central Bank should be cutting interest rates to help me. All of this stuff, it's too easy to blame that for our lack of success. The chances are that the trading problems we're experiencing are between our ears. They're in our head, in our own psychology. And by being reminded of this, based on our historical trading activity, is a useful way of keeping bad habits in check and learning from mistakes that we may not even be aware that we're making. And that's the whole idea behind our AI. Okay, that's it from me. If you have any questions now, I'm free to take them, but any questions afterwards, you can drop me an email. My email address is david.jones@capital.com, and to find out a bit more about the company and what we're doing with AI, then of course go to our website, which is capital.com, not surprisingly. Thank you very much.